contract or spot in the truckload market? Going to be talking about that with my guest today, Chris Caplice. He is Chief Scientist at DAT, and he is Senior Research Scientist at MIT's Center for Transportation and Logistics. Hi, Chris.
Hi, Robert. Glad to be here.
Thank you for being with me. So we know the truckload market is dominated by definition by contract rates, but during the pandemic, we saw a greater uptick in the use of spot rates.
Right.
So what has happened since then?
Yeah, it's kind of funny. The truckload market, as we've talked in the past, is cyclical. It goes through periods where capacity is tight, where demand exceeds supply, and where it's loose, where it's just the opposite. And how that market moves kind of dictates the use of spot. So looking back to the last capacity crunch we had, 2017, 2018, the use of spot went from a historical level of about 11, 12% to 20%. But then in 2019, when the market softened up again, it went right back down to 12%. During the pandemic, it went up all the way up to 25%, so much higher. But interestingly, unlike the previous soft markets, it only came down a little bit, like to 20, 21%. So something's different now. More shippers are still using spot, even though the market is a lot softer. So that's a big change from historical precedents.
I take it the assumption is the attraction is that the spot rates are cheaper than the contract rates.
You would think, but that same thing happened in 2019. The spot rates inverted. So whenever the spot rates drop below the contract rates, we call that an inverted market. And right now we've been inverted since April 22, so we're approaching, 16, 17 months? But that same condition happened in 2019, but we didn't see the use of spot increase. What we did see, though, is there's different types of spot, and that's what we're finding out. The spot that happens because your routing guide failed, we usually do a bid. The winning bid goes into the routing guide. If they don't take it, it goes to alternates, and then it goes to spot. We're finding that percentage that goes spot decreased dramatically now because, as you said, spot rates are so much lower. Most carriers are accepting everything, high acceptance rates. What we did see, though, an increase in the use of spot that goes direct to spot. It doesn't touch the routing guide.
Not even considering the contract rate.
Shippers are accessing the spot market a little differently, it seems.
So the first one is spot as a course of last resort.
Failure. When the routing guide fails.
And this one is we go right to the spot market because it's so obviously more attractive. Why bother with the contract rate?
See, it could be for that. It could be purely opportunistic. But we're also seeing that shippers are realizing that, not all lanes are the same, not all pigs are equal, right? And there's certain lanes, and it's usually about 50 to 80% of the lanes carry a very small percentage of the volume. And if you put a contract rate on them, they tend to fail anyway. We've shown this at MIT during many studies we've done there, at DAT as well. And as the volume decreases annually, the probability it goes to spot and fails in the routing guide increases exponentially. So it begs the question, why am I putting a contract rate on these lanes that are going to fail anyway? And so that's what we're finding is that, a lot of shippers are saying, sure, it's 60% of my lanes, but it's only 10% of my volume. Why am I spending all this time setting up a contract? Half the time those lanes don't even materialize the next year. So it sets up problems. And so there's a way of thinking about maybe I handle those lanes in a different way.
Well, what happens when capacity becomes constrained and it's more difficult to get truck capacity? The trucker's more in the driver's seat, no pun intended, about being able to reject a spot offer, or they simply got to take what's...
it's a great question. That pun was totally intended. So in a tight market, you expect to see the acceptance rate drop, right? Because carriers have better options. And so using spot there actually makes sense because you can either... It's like, what is the definition of reality? It's that thing which when you stop believing in it still happens, right? And so the spot market will still be there. The question is, do you wait and go through your routing guide, which will take, if it goes to the second, third, fourth, fifth alternate, that can take a day. Or do you go directly to spot with a relationship with a carrier or a broker that has a different kind of relationship, a different kind of contract? So it's not contract where the same rate for the whole year, it's a little more dynamic. And so what we're finding is there's an advantage for that, not for all your lanes, not for all your volume, but for those painful lanes that are low volume, not that much going through, but a lot of your lanes fall into that category. And so it's a way to procure a different type of lane.
Okay, so the big question now, blip or a trend?
Yeah, I think it's definitely a trend. A lot of people think it's opportunistic, and I'm sure some of that is there. But I think it's actually more of a trend because a couple things that have happened. One is the technology is there. API connections, it makes it easier to be dynamic. We're not slaves to EDI as much anymore. which is great and very efficient, but not very flexible, very brittle. And then the other is there's a little bit of acceptance by people for uncertainty, just like we became accepting of fuel surcharge with fuel prices. People are accepting that, hey, the market moves. I don't control the market. You don't control the market. So maybe that piece of it that's most susceptible, I bucket that and treat that differently. And then the third thing is the algorithms and techniques, the data analytics to actually forecast what a rate would be today, tomorrow, has improved dramatically. And so combining all those things makes it so that dynamic rates in the spot market are much more predictable, if you will.
Yeah. My assumption is contract rate strategy, spot rates tactics. Maybe not the case. I mean, how can shippers actually use spot rates in a strategic way?
Yeah, it's a great question. And so if you look at the whole continuum, you've got the random one load a quarter kind of lanes going to North Dakota. And then you've got these heavy lanes that are going back and forth DC to vendor, and you can make a continuous move out of that. These are dedicated, and you can set up a private fleet, do dedicated. And then on this side, you want to do something like what I described, but in the middle you have contract rates. And those contract rates are set up for a year, but those should be high volume-ish lanes, maybe that aren't balanced. But in between contract and pure open market spot, there's a continuum there now. And so the question is, how do I make my contract annually? There's no flexibility in it. The price is set.
Yeah.
How do I add some dynamic nature to that? And so at the very end, you've got the spot where it's you're deciding the carrier and the price at the time of tender, but you might be able to bring something up and say, you know what, I'm basing it off an index rate, load by load, whatever market rate you want to use, plus 5%. And you agree on that, shipper and carrier agree to a third-party index, and then based on that, that's what they will move the rate at. Moving up a little more, you can have index-based rates that get adjusted monthly, quarterly, weekly, where they look at the past period, adjust it for the next period. And those are fairly common. But the big thing we're seeing, is a long-winded answer, is that dynamic nature is moving into contracts. And that'll do a couple things. One is the bidding process will be easier because you'll have fewer lanes for that contract. And also the contracts are being made for lanes that are suitable for contract, not just every lane. Because one of the problems with truckload is they use contract rates for all those lanes. And they tend to fail. And the ones that fail are these ones that you should procure differently.
So you put dynamic rates in, and yet they're still called contracts. I mean, you think of them as being in total opposition to one another, but it does feel like the carriers would like that because they're given them more predictability. They're going to hold on to the contract side of it and not watch the shipper escape into the spot market.
Right, and so there's different dimensions to contract, right? One is that carrier going to get it, and then the second is the price. And so carriers, yes, they want to have that, and for some lanes, they're willing to say, you know what, we won't go whatever price you want, but if we'll look at a trusted third-party index, and if we both agree to that, we'll move on that. Right. And this is what more carriers have programs that do this, whether they're pure 3PLs or asset-based carriers with brokerage arms.
And shippers then can budget these rates into their transportation budgets.
That's the challenge, yeah. So how do you incorporate this planned spot into your budget? Usually you do a bid, you get the RFP and the results, and that became your budget, the routing guide. And now you've got a little bit of flexibility. So it's a little more difficult to figure out. You can put ranges on it, and so that's what the best you can do. But just like budgeting for fuel, how do you do that? You know no one's going to control the price of fuel, so you set up a bucket for that. You can do the same thing for the market lanes.
So I ask you, I say contract or spot, and you say yes.
Yes.
It's a lot more nuanced than
all
one.
Spots are the same. Yes.
Right. Thank you so much, Chris, for that. Really interesting insights into the truckload market there. But I'd like to ask you very quickly about DAT. Yeah. What is that? Who is that? What do you guys do?
So DAT has been around for about 45 years, and so the piece that I'm on is DAT IQ, and we're trying to conquer that piece of the business. We understand that some parts of your shippers network should be done by contracts, some should be dedicated, but we think a lot more can be done by spot, and we're there to provide that index, provide those insights to make sure that both you and your vendor, whether it's a carrier or a broker, are in agreement. We can be that trusted third party to set that rate that everyone can agree to. So we try to be that neutral information platform in the middle between the shipper, the broker, and the carrier that makes the whole market more efficient.
Thanks again, Chris. Appreciate your insights into the truckload market as well as a little bit about DAT as well. Really appreciate you being with me today.
Great. Thanks for having me.
Thank you. I have been speaking with Chris Caplice of DAT and the MIT Center for Transportation and Logistics. Thank you very much for watching.